You've seen the headlines. Silver breaks $80. $100 next. The biggest short squeeze in history. Some channels are calling it the beginning of a monetary reset. Others are framing it as the trade of the decade that nobody saw coming. Let's slow this down. Silver trading at $80 would be more than double its recent range in the low to mid-30s. That's not a small move. And if we're talking about $100, we're talking about territory silver has never seen in nominal terms. Today, I want to separate signal from noise, not dismiss the move, or not chase the hype, just look at the data, probabilities, and what it would actually take for $100 silver to become reality. This is Financial Briefing, no clickbait, just context. Before we dive in, quick scorecard. Accountability matters. Back in late 2023, when silver was hovering around $22, I said there was a 60% probability we'd see $28 before $20. That played out within 6 months. Earlier this year, when we broke $30, I cautioned that momentum alone wouldn't carry us straight to $40 without a pullback. We retraced to $27 before resuming higher. Not perfect. Timing, but directionally correct. And 3 months ago, when gold started pushing new highs, I said silver would likely outperform in the next leg up, but that volatility would be brutal. Since then, we've seen 5 times 7% daily swings more than once, so we've been constructive, but cautious. That's the lens today. Oh, and let's start with the first hard data point, the size of the short position. According to the latest Commitments of Traders report, commercial traders, primarily bullion banks and producers, have been carrying a net short position equivalent to roughly 250 million ounces. That's not unusual in structure, but what stands out is concentration. The top 4 traders account for a disproportionately large share of that exposure. Historically, when commercial net shorts exceed 200 million ounces during strong price uptrends, volatility expands sharply. We saw similar conditions in 2011 when silver ran from $30 to nearly $50 in a matter of weeks. What it means: if price accelerates and forces short covering, the move can overshoot fundamentals. Short squeezes are mechanical. They're not about valuation. They're about positioning stress. What it doesn't mean that every large short position leads to a squeeze. Commercials are often short because they're hedging physical production or acting as liquidity providers. They've historically been early, not wrong, at major turning points. In 2011, commercials were heavily short near the top. The squeeze ended and price collapsed 30% in days. Second data point, physical market tightness. COMEX registered silver inventories have declined over the past 2 years from over 150 million ounces to closer to 90 million ounces. That's a significant drawdown. At the same time, industrial demand, particularly from solar panel manufacturing, has grown meaningfully. The Silver Institute estimates global silver demand at around 1.2 billion ounces annually, with supply lagging slightly behind. We're running modest deficits. What it means? The structural backdrop is tighter than it was 5 years ago. If investment demand spikes on top of steady industrial consumption, the physical market constrained. That's supportive for higher prices. What it doesn't mean that vaults are empty or that they're an imminent delivery failure. Total above-ground silver stocks are still substantial, and in past rallies, scrap supply rises quickly. At $80, you'd see a surge in recycling and hedging. High prices cure high prices. Third data point, volatility and options positioning. Implied volatility in silver options has expanded to levels we haven't seen since 2020. Open interest in out-of-the-money call options, particularly in strikes equivalent to $60 and $75, has increased sharply over the past month. When speculative call buying accelerates, market makers hedge by buying futures. That can amplify upside moves in the short term. What it means? Part of the rally narrative may be self-reinforcing. Momentum traders, options flows, and algorithmic systems can drive price beyond traditional valuation metrics. What it doesn't mean that those flows are permanent. When call buying slows or reverses, that same gamma dynamic can work in the opposite direction. Silver is notorious for round-trip moves. Now let's outline the bullish case clearly. First, structural deficits continue for multiple years. Industrial demand from solar, EVs, and electrification keeps growing at 5 or 8% annually while mine supply stagnates. That creates a sustained supply-demand imbalance. Second, gold continues making new highs above $2,400, and the gold-to-silver ratio compresses from the 75-80 range down toward 50. If gold stays firm and that ratio mean reverts, silver at $80 isn't mathematically outrageous. Third, real yields decline. If the 10-year Treasury yield falls from 4% toward 3% while inflation expectations remain sticky, the opportunity cost of holding silver drops. Fourth, a genuine short squeeze materializes. Commercial shorts are forced to cover into a thin market, accelerating price through technical levels like $50, $65, and beyond. Stack those together, and a spike to $100 becomes possible. Not base case, but possible. I assign roughly a 30% probability to a sustained move toward $100 within the next 12 to 18 months. Not zero, not dominant, but meaningful. Now the bear case. First, silver is historically volatile and prone to blow-off tops. In 2011, it nearly touched $50 and then fell to $35 in days, eventually dropping below $20 in the following years. Second, industrial demand is cyclical. If global growth slows or enters recession, silver demand from manufacturing could soften, offsetting investment inflows. Third, the US dollar. If the dollar index strengthens back above 110, precious metals typically struggle. A stronger dollar tightens global liquidity. Fourth, elevated prices incentivize supply. At $80, marginal projects become profitable. Producers hedge aggressively, scrap flows surge. The deficit narrative weakens quickly. In that scenario, what looks like a historic squeeze becomes a violent spike, followed by a 30-40% correction. I assign about a 35% probability to the move fizzling below $70 and retracing significantly before any sustainable breakout to $100. So what's the middle ground? The middle case, and my current base case, is that silver breaks higher, perhaps tests the $60-70 range over the next year, but does so in stages. We get sharp rallies, sharp pullbacks, and elevated volatility. The gold to silver ratio compresses moderately, not dramatically. In this scenario, $100 isn't impossible. It's just further out. It requires either a broader monetary event or a multi-year structural squeeze, not just momentum. I put about a 45% probability on that outcome. Strong upside continuation, but not a straight line, and not immediate triple-digit silver. Let's zoom out historically. The closest comparison is 2011. Back then, silver ran from under $20 in 2010 to nearly $50 by April 2011. The narrative was currency debasement, quantitative easing, and retail speculation flooding into metals. Similarities today: elevated debt levels, persistent deficits, central bank gold buying, and retail access through ETFs and options. Differences. In 2011, silver ETF inflows were exploding at unprecedented rates. Today, while interest is rising, we haven't yet seen the same retail mania. Also, back then, inflation expectations were lower. Today's environment is shaped by post-pandemic inflation psychology and higher nominal yields. Another difference, industrial demand now plays a larger role relative to a decade ago, particularly in green energy. That gives today's rally a slightly more structural component. But remember, in 2011, silver didn't gently consolidate at $50. It collapsed. History doesn't repeat exactly, but it rhymes. Now cross-market context. Gold remains the anchor. If gold holds above $2,200 and continues trending higher, silver likely stays supported. If gold rolls over sharply, silver usually falls harder. The dollar index is critical. A sustained break below 100 would be supportive for metals. A rally back above 108 to 110 would be a headwind. And the 10-year yield. If yields drift lower toward 3%, that's constructive. If they spike back above 4.5%, it increases the opportunity cost of holding non-yielding assets like silver. Right now, cross-market signals are mixed. Not screaming crisis, not screaming collapse. Positioning adds another layer. The latest COT report shows managed money net longs expanding, but not yet at extreme levels seen at past peaks. Commercial shorts are elevated, but within historical bands. That tells me we're stretched, but not euphoric. Not yet. Institutional behavior matters too. ETF flows have picked up, but we haven't seen massive inflows on the scale of 2020. That could change, and if it does, it would amplify volatility. So here's my personal framework. If silver holds above $60 on weekly closes and we see continued ETF inflows plus declining real yields, I add to positions on pullbacks. In that scenario, I target a staged move toward 85-95. If silver spikes toward $90, $100 in a short period, say weeks, not months, I trim aggressively. Parabolic moves rarely sustain. If silver fails to hold above $70 and breaks back below $60 with rising yields and a strengthening dollar, I reduce exposure and wait. Currently, my allocation is roughly 15% physical silver, 10% gold, 5% in mining equities. I keep 70% in diversified assets and cash equivalents. My stop loss on trading positions would be a weekly close below $58. My first take profit zone would be $88, $95, scaling out rather than exiting entirely. This is not advice, it's just my framework. And here's what I'm not doing. I'm not panic buying because the headline says $100 imminent. I'm not binge watching fear content predicting systemic collapse tomorrow. And I'm not assuming that a price spike equals monetary reset. Discipline beats drama. This week, I'm watching three things closely. First, the gold to silver ratio. If it compresses below 60 decisively, that's bullish momentum confirmation. If it rebounds back above 75, that suggests silver underperformance. Second, ETF flows. Consecutive days of strong inflows would support the squeeze narrative. Outflows during a rally would be a red flag. Third, the dollar index. A break below 100 with follow-through would reinforce upside. A sharp reversal higher would likely pressure silver quickly. So let's summarize. Silver at $80 would represent a historic breakout. A move to $100 is possible but not guaranteed. Positioning and physical tightness support upside, but volatility cuts both ways. And probabilities matter more than headlines. If you value calm, data-driven analysis without hype, subscribe to the channel. We'll continue tracking the numbers, not the noise. This is Financial Briefing. Stay sharp. $100 silver incoming. The short squeeze data. Nobody is explaining.